All right, very good. I am Tim Parati. I am joined as always by Drew Dawkin. This is the WealthVest Bull and Bear podcast. We are happy to be joined by Danny Dayan for the second time. Danny, I'm sorry, is it Dayan or Dayan?
It's Diane. Diane, like the woman's name. So when I was a kid, people would always say I should marry a woman named Diane. So she would be Diane. Diane.
Do most people get the guess on Dayan?
Yes, they do. They do get that wrong. A lot of people do.
All right. So hope that wasn't too annoying for you to. But anyway, yeah, I mean, I'm a big fan of Danny's work. He has a great Substack letter. But why don't I let you, Danny, talk a little bit about your background and what it is that you're doing now, and how you kind of built the methodology, the really thoughtful and robust methodology that you use.
Sure. So my career has really spanned two areas. One is macro and the other is derivatives. I've really always been focused on the intersection between the two. Formerly was a hedge fund manager running my own hedge fund, DWD Partners. After closing that, I ended up joining Twitter, mostly to just stay on top of markets because I didn't have access to the brokers that I normally do. And I ended up, enjoying the engagement with people in sharing, my thoughts on macro. And this was around the time of Silicon Valley Bank and whatnot, when people were very confused about the macro. In that process, people started, wanting to learn more about what I was thinking. I ended up starting a Substack, and it's a long form way of me explaining, my views, very much a quantum mental sort of research process. Very data driven. Everything I do involves, quantitative frameworks and modeling, but it also requires, macroeconomic intuition, experience and study from that front. And then when I form macro views, I tend to cluster them into themes. I then look to the derivative markets and see, where do I have an edge in expressing, this view. And that's in a nutshell what I do across the major macro markets.
And a lot of what you're selling, what's below the paywall, is how to express a lot of your views.
Yeah, detailed research. Here's my asset class exposures. I also have a daily chat room where, we're discussing the daily dynamics. We're discussing, quick trading decisions, hedges, exits, stop losses, whatever they may be. So absolutely, it's a combination of here's how I see the world, and then here's how I'm expressing it.
Now, I think what's interesting is a couple of months ago, and I may have the timing wrong, you got more bullish on the growth cycle, I think, than the rest of the street did. And I think that the rest of the street, including the Fed, is kind of caught up to you a little bit, right? But you definitely were early in saying, you know what, we may actually be right on the cusp of stronger labor and stronger growth. So I think what we're going to do is we're going to run through your slides that you've put together here, and we're going to run it in 5 different parts. You're going to run through the labor market. You're going to talk about sentiment, inflation, tariffs, and your view on, the transitory nature or maybe the more sticky nature of tariffs. And, that's my favorite topic. And then we're going to talk about a lot of your framework is around your FCI, your financial conditions loop. So we want to get into that. And then I think that can help us kind of summarize where you think big picture, the kind of the major indexes and fixed income and equities are heading.
Absolutely. So let me get the presentation up. Bear with me. Can you see my screen?
Yes.
Perfect. So first of all, when I look at the economy, aggregate demand still remains very strong. Okay, so when we look at things like, I tend to look at growth relative to its potential. In a typical cycle, you will see, ahead of a slowdown, you'll see actual growth, the trend of growth compounded over the cycle, start to decline or moderate its pace of acceleration and catch up with potential growth. If you look at this cycle, and obviously we don't have Q3 yet, but it's tracking very strong, is that we're well above potential. And this sort of divide between the two, the difference between the two, you can think of that like excess demand, and excess demand is what leads to inflation. You look at on the right, we have financial conditions. This is the Bloomberg Financial Conditions Index. We'll go through my framework, a bit later. But going back to the 90s, this is some of the loosest financial conditions, we've ever had.
Right.
Now,
And Danny,
on the other hand, the labor market. Yeah.
Danny, if I could just interrupt for a minute, just so people understand what you're talking about. There's some people who may not understand what potential GDP is. Potential GDP is the rate at which an economy can grow without pushing inflation too high. And what you're illustrating here is that we have very loose financial conditions, whether it's the Bloomberg Index, the Chicago PMI, the Chicago FCI, your framework, and that is keeping inflation high because it is keeping our growth rate above our potential growth rate.
That's right. So potential growth is a function of the growth in the labor force and the growth in productivity. And, these factors don't tend to change very much over the course of a few years. They don't tend to change over the course of a cycle, for example. This is the long run sort of potential growth of the economy. Think about it like the capacity of the economy. Now, the economy in a cycle, in a given business cycle, can grow faster than potential, or it can grow below potential. And, that could be due to policies. It could be due to shocks. There could be a market shock. There could be a geopolitical, dynamic that could cause us to deviate from potential. And typically, when we're growing above potential, the Fed wants to be restrictive on policy. And when we're below potential, they want to be easing because, clearly the economy needs support. And so what's very unusual about this cycle is that they've been easing and have done a material amount of easing at this point, despite never having growth, return to potential at all. So growth in aggregate remains strong, although a lot of people, when you talk to them, feel like it's uneven, right? They talk about K-shaped economy, or, the generational divide, which I tweeted about today, where the baby boomers have, done so well, but the younger generations feel like this economy is not helping them. There's a lot of these dynamics, but in aggregate, we're growing well above potential this cycle, and persistently. So moving on to the labor market, it is a pretty complicated labor market to analyze. It's not as straightforward as you would think. So obviously, when we talk about anything like labor, there's a demand side and there's a supply side. Trump's policies, basically in reversing the immigration flow from Biden, have collapsed what we call break-even level of employment. And so in the chart on the left, this is a model that I created, and the Dallas Fed has a similar, result that I do, where using things like population growth, labor force growth, what is the level of job gains that we need on a given month where the unemployment rate doesn't move? By my estimates, this was very high for 2 years due to the flow of, immigration that we had under the Biden regime. Not only did, Trump completely stop that, but he's also been deporting, quite a bit of people, immigrants, illegal immigrants. And he's also, frankly, not been very encouraging on the legal immigration front either. So all told, we have a collapse. And my estimate is it's about 30 to 35K on a monthly basis, the break even. And, I put on the chart on the right, to look at this going back all the way to the 1960s, using the same model and framework that I did, as a percentage of the labor force. And you can see that this is unprecedented. I mean, only in 2020, when everything was shut down, have we ever seen anything like this. And the importance of the chart on the right is these dynamics have been going on for quite a while. Trump is not, the only one that has, dictated this. He's just accentuated the dynamic this year in a big way. But these dynamics have been going on due to population, demographic dynamics for quite some time. Moving to demand, clearly demand for labor has also softened, but it's not contracting. And I think that's very important. So as the supply of labor has come down, so has the demand, and the demand is visible with lower job gains per month. But when we look at things like the layoff rate, the JOLTS layoff rate for the private sector is basically unchanged for 3 years. Jobless claims, basically unchanged for 3 years. So we're not contracting, but we are not hiring as many people as we used to. In actuality, and as I mentioned in the first slide, it's clearly not an aggregate demand issue. We look at corporate earnings. These are the companies that hire people, right? Corporate earnings are exploding. We just had Q3 was very strong, and then look at the guidance on the chart on the right.
Yep.
In the last 15 years, we have never seen as many companies raise guidance and reduce their cautiousness as we did in the most recent quarter. So clearly, overall economy demand is not the issue.
Right.
Right.
So Danny, let me just interrupt you to help explain to people why that matters, right? We happen to use a framework that is exactly that. We use the HOPE framework to just talk about markets and talk about the cycle: housing, orders, profits, employment. It is not until profits roll over that companies want to protect their margins and therefore start to lay off people. So it's hard to imagine that we're going to have a sort of deepening labor recession when, as you have pointed out here, the momentum and the profitability of corporate America, and the breadth has actually improved of late. It seems hard to imagine that all of a sudden you're going to have layoffs accelerating at the same time that profits are accelerating.
That's right. And, on top of it, given the, supply situation, I think a lot of the corporate sector recognizes that, I'm sure there's a lot of companies and industries that want to tweak their payrolls on the margins, maybe cut some staff to trim some fat, and kind of see the situation, maybe then come back and hire. But with that low labor supply, the issue is that, they would have a lot of trouble potentially getting those workers back. And so I think the phrase that you hear is low fire, low hire, and that is accurate. That is accurate. Where I'm getting at with this slide in particular is, the Fed, when the Fed comes in to support the labor market, they only have one tool, and that tool is to cut rates. And the question is what they're doing, one, is it working? So far, we're 175 bips in and nothing has really changed in the last, 15 months. And secondly, if aggregate demand is good, then the issue is probably something outside of their control. And in that case, they may be making a mistake on their other mandate. And we'll get to inflation, shortly.
Yep.
But look, do we have potentially some labor improvement ahead? We might. Some of the early cycle indicators, and it's really weird to be talking early cycle, but I'm seeing a lot of early cycle indicators suggest that it's possible that the last few months companies were very cautious because of the tariff shock, because of all these things coming on. They didn't know how this would play out. They've been very cautious. And now that we see the Fed is, easing in a counter-cyclical way, and we see financial conditions as easy as they are, and we see, very close to record stock prices, that maybe it's time to start hiring. Well, a couple early cycle indicators: the temporary staffing index has surged. It's really surged in a way that you typically see early cycle. The Atlanta Fed wage tracker, you see that, wages have been quite flat overall, but job switcher wages have popped from 4 to 4.6%. Maybe that's a sign that at least in certain sectors, it's tightening. The small business survey, NFIB, had one of the largest, I should say, improvements on a month over month basis in hiring intentions. You can look back in history to see how rare it is to see something like this. It's actually very much like an early cycle dynamic. You saw it in 2020. You saw it, coming out of the 2001 recession. You saw it coming, in 2009, 2010. And that's where we are today, which looks like maybe an early cycle dynamic. You can see on the chart on the right, which has the hiring intentions with private payrolls, and it tends to lead, although it's of course a loose relationship, but it tends to lead. So maybe the worst is past us, and that's sort of what I'm thinking as well. In that, the dynamics I'm seeing. I'll just speak because we did get a labor report yesterday, and what's interesting is private payrolls have improved for the last 3 months. Labor force participation rate is up for 4 months straight, and the labor supply, the labor supply was zero. Growth in the labor supply was zero from January through August. Obviously, immigration a big reason why, or lack of immigration. It has gone up by 800,000 since September. And so, what does that mean? It means we have new entrants into the workforce, and, frankly, it takes them time to get jobs. It's possible that the unemployment rate in the last couple months, I'm not talking about what has happened before that, but in the last couple months, we went from 4.3 to 4.55. And that last move looks more because of the labor force and new entrants coming in than it does, let's say, layoffs or anything of that sort. Now, you can look at that two ways. I have to caution, one is these people that have entered the workforce, if they don't find jobs, then, it's a material loosening in the labor market, and the unemployment rate, will be sticky and harder to bring down. But if it's just a timing issue or a matching issue, well, then before long, these people will have jobs and the unemployment rate will come right back down. And so I think, it was a very interesting report on that front because everyone looked at the unemployment rate, but not too many people looked at why it went up. And I think that was important.
Yeah, and just to explain, the unemployment rate is derived from the household survey, not a particularly high quality piece of data, all things being relative. But what is interesting is that, as you say, had you kept labor market participation constant, you would not have had the rise in unemployment. And generally, the thought is among economists that labor force participation rises ahead of hiring because there is some optimism that there are available jobs out there. Drew, I think you had some thoughts on one question.
Well, one thing, Danny, is this past year we saw healthcare amount for 47% of job growth, and then we saw a manufacturing recession. So, do we see that kind of dynamic going into 2026? Is it going to be healthcare centric and kind of more sluggish on the white collar side of the manufacturing side, or what's your thoughts if we look under the hood at like who's getting hired and what sectors are doing well?
So I think are you guys familiar with the QCEW annual benchmark revisions that we get?
Sure. We had Mike Green on the podcast. How could we not know about the QCEWs?
All right. So normally this is a very backward looking, we just adjust the payroll report relative to some assumptions that went into job gains and we revise it, typically revised lower, not higher. But it was lower this time. I think that adjustment was very important this year. And so the reason I say that is it was, it took the 2024 payrolls from 140K average down to 70K average. And so why is that important? It tells me two things. It tells me that, number one, most of the immigrants, or, the ones who crossed the border illegal, we call them migrants, I guess, did not actually get jobs. The models assumed they did, but they actually did not really get jobs. All that flow of labor did was distort the actual economic data in both directions, made it look stronger than it was and made it look weaker than it is today. And the other thing is that the sort of dynamics of like what Drew was just talking about, where we have very narrow job gains and very low job gains, has actually been in place for about 18 months.
Yeah.
So in that period, the labor market has been very consistent with just mostly driven by healthcare and government jobs. And then you have, a few sectors here and there that are good one month and a few sectors here and there that are good the next month. But it tells you that, the labor market has actually been pretty stable for quite a while at this very uncomfortable low hire, low fire regime. Now, if you're me, my interpretation is that this is what full employment looks like, where, if you guys lose a worker, you need to hire a worker. But if you don't lose a worker, you're pretty comfortable with your staffing and don't really need to add too much. And we've never had an extended period of full employment because the Fed usually murders the business cycle.
Right.
And so it's been a very long time since we've had an extended period of that. So now to answer Drew's question, I think if we look at the last 15 months, the Fed has actually delivered. We used to think it was a soft landing, push for soft landing. We used to think it was, adjustment cuts, 1990s style. It looks to me like they've just delivered a full easing cycle in the course of 15 months at a period where the unemployment rate's gone up 0.2%. And I view it as almost like the 1960s. I think that we'll probably have a very strong cyclical acceleration. And I think you'll see like these screenshots here, small businesses should start to improve their businesses should improve, their hiring should thus pick up. I don't know that manufacturing will ever do well when we have this tariff regime we have, but I do think that other sectors like housing can start to improve. Things of that nature, while we still have, the AI, dominance. So I'm expecting a cyclical improvement in 2026, almost like we're starting a new cycle. And I think that's a very out of consensus view.
Yeah. I think a couple things I want to just mention is that what you meant with the QCEW revisions about there's no rate of change negative, right? Hiring and firing have been really, really flat for an extended period. So the more we understand that, the more we understand that there's no negative momentum in the labor market. The question I have, I guess the pushback I have is, can you get cyclical hiring growth without construction driving it? And, when you look at the XHB, we had Lennar report week again today. You just aren't getting great absorptions. Even with the long end coming down, you're not getting new home absorptions. Home Depot was pretty punk when they were talking about their outlook. You really have poor private residential investment spend. How do you think about that?
I think the housing market is very distorted and unlikely to completely unwind that. So we still have an excess 25 to 30% of the existing home market that is just frozen. These people are not going to get out of their mortgages at 2 to 2.5 or 3%. Yeah. You're pointing to yourself. I mean, unless something drastic changed in your life, you're likely not leaving that home. And so I think when you look at things like housing volumes and things of that nature, it is not going to change in a material way. That being said, since we've had rates come down, the 10-year approached 4%, and been around here for a few weeks, we've actually had mortgage purchase applications improve to the highest in 3 years since 2023. And, we've already seen existing and new home sales put in some decent improvement in the last couple of months. And I think we can see some more of that ahead. For builders in particular, for them, the concern is you need price growth. So, they're trying to sell homes and they want prices to be rising in order for them to, sell. And that process looks a little bit slower to materialize because we are still growing inventories. And so on a year over year basis, inventory growth is about 13%. And that typically has a downside pressure on prices. But it was 35% just 3 to 4 months ago. So the rate of change has slowed. And as that slows and gets to zero or potentially negative on inventory growth, then I think you see prices stabilize and the builders would be incentivized to build more. But I don't necessarily see that dynamic. I still see a situation where we get these like pockets of demand when rates come down, or prices coming down is also another possibility. That leads to little pockets of demand that last a few weeks, and that translates into a month or two of good data. But to see the full scale improvement, you would need to unlock that existing home sales market, which I just don't think is going to happen. So I think it's going to stay this sort of dynamic for a while.
What's extraordinary is in housing is I, like a lot of people, a year ago or so, started writing about, look, you're going to have weaker employment because you're going to have construction employment unwind. When you have construction labor at all-time highs or near all-time highs, and yet permits and starts rolling over, you are going to see some weakness in construction-related employment. But it would seem that there is such a tight labor market, so much of that labor has been deported or not in the country, that so much of that is easily absorbed in the kind of the remodel and refurb market. Because if you talk to anybody in remodel and refurbish, I'm in the New York area, they'll tell you they can't find people. And that's what the NFIB says, right? Even people in the construction market, as weak as new construction is, most people still can't find labor. So it's extraordinary this dynamic.
Yeah. We made new cycle highs in the construction payrolls this month. So, it's still growing. And I think, like you said, there's been, it's a sector that's reliant on immigrant workers. And so maybe this is an early cyclical tightening that we see that translates to other sectors. We'll have to see. It's, when I say like we have some new cycle dynamics, it's not exactly the same as when you come out of a recession where everything contracted, right? We've had rolling sectors that are doing exceptionally well, and we have other sectors that are doing weak. And so, but we do see some pickup in some early cycle dynamics. And even in the markets, you're seeing cyclical sectors start to lead, substantially. Now let's move on to, the next section, which is consumers. Consumers, even though they're spending, they are very, very unhappy, and when we look at, things like, Trump's approval rating, which started out very, very strong, early on, has collapsed, certainly. The big one, I think, is if you look at inflation, where he's all the way down here, at the bottom at 34%, approval rating started at 45%. This has come way down. I don't think he's helping himself with saying, in affordability, the Democratic hoax. This is the sort of thing where, politicians exaggerate, they embellish. This is nothing new. That has existed as long as time itself has existed. But with something like affordability or inflation, you can't really BS consumers because, as soon as we close this call, one of us heads to the store or grocery store and we feel it right away. And we feel it every day. And so you cannot just dismiss this, in my opinion. If you look at the University of Michigan consumer expectations, this is on par with the biggest catastrophes we've ever had. It's on par with 2008, 1980. Like, we're talking very deep recessions, and yet we're still growing GDP well above potential. So this dynamic is coming from somewhere. And when I dig into it, I think it's inflation that is the issue. It continues to be the issue for consumers. So on the chart on the left is what I call the adjusted misery index. The misery index is simply take the unemployment rate, which is 4.5 or 4.6, and take the level of inflation, add those two together. And if you had that, misery index, it would be about 7.6%, which is one of the lowest ever. You would expect consumer sentiment to be, wonderful, extremely strong and extremely high, but it isn't. And so what I did is I dug into it and I adjusted the misery index. Instead of using official CPI at 3%, I used consumer inflation expectations from the University of Michigan, the mean inflation expectations. And when I put that together, you get this misery index that really is on par with the consumer sentiment that we were seeing. It is on par with the 2008 experience. It is on par with a 2020 or 1980 experience. And so I believe it's inflation that is still the number one issue for the consumers. And a lot of people talk about, is it the price or is it inflation? I think it's inflation. I think we don't have to try and twist it, in that way. On the chart on the right is one of my favorite ways of looking at this, which is basically saying take nominal consumption growth on a given month or a year, and then take inflation. How much of that consumption is simply just inflation? And if you look, we're at 51%, which is very high. The magic marker is 60%. If we get to 60%, every single time we have gotten that high, a crisis has ensued, or either a recession or a crisis. Now, it can come from either direction. It could come because inflation is sticky and consumption falls. That's an old-fashioned recession. Or it can come from inflation just growing too fast, and nominal growth doesn't change, and it eats up more and more of your spending. And as that happens, typically the Fed would be tightening to end the cycle. And so, at 51%, this is something I monitor every month. We're not far from that crisis level of 60%. And I think, this is very important. And, the thing is, if you listen, sorry, go ahead, Tim.
No, I was just going to say, if I'm an old retail analyst, right, an old consumer analyst, and one of the things that you always looked for either consumer packaged good companies, retailers, restaurants, is when sales were up on down volumes, right? Traffic is down 4%, but, mix was flat and sales were up 1% on 5% pricing. And if you listen to 100 calls from Nestle to Starbucks, that is what you are going to hear. You're going to hear negative volume on up pricing, right? So and that can work for a while, but it tends not to work for very long because ultimately the consumer rejects that.
Yeah, and we're seeing that, and we're seeing consumers very unhappy for it. And that's why I say when you look at nominal consumption, aggregate demand remains strong, but it's coming a lot from prices. Basically 51% by this metric, and that's if you assume CPI is PCE is accurate, right? Like it could be understated in a number of places, but most people I talk to think inflation is higher than the 3% that they get from the official statistics. But keeping that aside, using the official statistics, if half of your spending is simply price increases, that's a recipe to be, deeply unhappy as a consumer. And I think that's what we're seeing. We're definitely seeing that. And, the Fed comes out, and in the press conference, Powell has basically said, it's just tariffs, right? Without tariffs, we'd be at our target. And I thought that was a really disingenuous comment from the chairman. And, you don't typically see the Federal Reserve, like politicians, exaggerate or lie in that way. But this is what I'm seeing. If we look at the categories of inflation, the breakdown of the distribution of inflation, if you look at December 2019, 26% of categories were in outright deflation, negative price growth, a lot of goods prices in particular, and only 24% were above 3%. If you look today, we only have 14% that are below zero, and we have 47% that are above 3%. So clearly, it is more broad than I think the Fed wants to acknowledge. You look at, for example, core services inflation, but stripping out housing, on a year-over-year basis, it's 3.3, and on the chart, you can see where it was in 2019. It was 2. Right. So clearly it is elevated relative to what used to be when we were a 2% economy. The 3-month run rate is 3.6%. So it may even be accelerating again. And so, I think this is the real issue, from inflation, is that when you see services inflation, ex housing, that is the most demand sensitive inflation. And it goes back to my earlier chart showing we're growing above potential. Then the thing that I find more frustrating with the Fed, and frankly, I would advise them to think about this more closely, is they keep saying inflation expectations are anchored, but everywhere I look, they look unanchored to me. So on the left, I have the University of Michigan. The average price is expected over 1 year. To be clear, there is the more popular measure, and you get a new one tomorrow, is the median. And the median is, as anyone knows with statistics, the median tells you that half the respondents are above this number and half are below this number. But the reason I like to look at the mean is because I want to know the tails. If we have a median of 3%, let's just say, as an example, I want to know if the ones who are below it are 2.9 or are they minus 5%, right? If we have a lot of people telling us they see deflation, that would be very valuable information that we'd want to know that demand is falling apart. On the other side, are we clustered around 3? If we're at a median of 3, are we at 3.2 or are we at 10? And I think that's important. So the average in University of Michigan is 6.9%. This should be very concerning for the Fed, that this is surging and is well above anything we've seen for many, many decades. The Conference Board is another version of the same sort of survey, and they're at, sorry, I can't see the number, but they're at, I think, 5.7%. And so, the Fed talks about inflation expectations as the most important thing for their transmitting of policy, and they're ignoring, metrics like this. Now here's a further example of this. The Boston Fed had a recent study out on the same thing that I was talking about, the mean inflation expectations from the University of Michigan. And what they did is they took a regression analysis and decomposed that number, the 6.9%, to fuel, energy prices, to food prices, and core inflation. And what's left over is this sort of unexplained component. The higher this unexplained component is, the more fearful you should be that inflation expectations are unanchored. And here you can see, I recreated this, how this looks relative to every period since the 1980s. If I'm the Fed, this is what would keep me up at night, is looking at something like this and saying, maybe we're easing too prematurely without having dealt with inflation. The Fed instead takes comfort from their preferred measures. And I think they're making a mistake with this. So they look at market traded measures, which is, inflation break-evens from the tips market. And they say, nothing, it's in line with what it was when inflation was 2%. So nothing to be concerned about. I think this is a mistake, because the Fed is taking comfort in a measure that they themselves have distorted. Right? Since 2010, the Fed bought trillions worth of nominal bonds more than they bought of tips bonds, right? So just using 10-year nominals versus 10-year tips, if you buy a substantial amount of nominal bonds and you buy fewer than that of tips, well, naturally, nominal bond yields will come down. And when they come down more than what tips yields come down, break-evens will narrow. I assessed that there's about a 60 bip difference in adjusting for these purchases. And so look at, and maybe my calculation is not correct. Maybe it's not perfect. But if you look at something like this, I don't think they would have the same comfort that they do about market-based measures if they had not distorted this market. I think that's important. The second way the Fed, I think, is making a mistake with their own metrics that they like to look at is the New York Fed inflation survey. And so they have a survey and they go out and they ask people two questions. One, what is the distribution, like a probability distribution of inflation that you expect over the next year? And then the other question is, what is the level of inflation that you expect over the next year? The second question is very straightforward, and they take a median of it. The first question, frankly, how many non-finance people do you know that think in terms of probability distributions? I don't know anyone. I'll go ask my mother tonight for a probability distribution of inflation, and she wouldn't even know how to answer that question. Whereas if I ask her, how much do you think prices are going to go up? She can give me an answer.
Sure.
And so if you look at the distribution metric, it's around 3.2%. The Fed can be like, oh, great. It's well anchored. Whereas the question of what inflation do you expect, the median, here it's 4.3%. It actually went up in the most recent month from 4% to 4.3%. And if you look at that, orange line, not only did it go up earlier than the other line and correctly foreshadowed the inflation that we got, it actually peaked around where inflation did and then came down earlier than inflation did. If I were to look at these two, I would want to look at the orange survey, the level of inflation that you're asking people what they're experiencing, because this is effectively been a better predictor of actual inflation. And so I think they're, again, I just think they're choosing, they almost have confirmation bias to say that they've solved inflation when it looks to me like they really have not and are misjudging this. And so, what is my takeaway from all of this is consumers are telling you one of two things. They're either telling you that inflation expectations are completely unanchored, right? That's the concerning question. Or they're telling you actual inflation is much higher than what's reported. And either message, I think, should be heard, by the Fed, that they're ignoring it.
Yeah, I mean, I couldn't agree more about the degree to which, especially when you listen to Powell's speech. I mean, he's got this optimism that you are going to have a housing market that holds up just fine, but will continue to provide you just enough disinflation to offset. And he doesn't use the word transitory, but he's got this confidence that tariff inflation is going to peak in Q1. And I think that sets you up for some of your next slides, because that confidence of the peaking in tariff impact on goods, just I don't know where that comes from.
Yeah, I fully agree, and I think they've had this very high confidence this entire cycle. And if you go through their dot plots, year-end dot plots, every year they've underestimated inflation, and it's not just 21, which you can be excused if it was just 21. Okay, no problem. But 21, 22, all the way through this year, they've underestimated it. So again, I think when you've been wrong at something for 5 years, you guys are investors. If you've had a bad run for not 6 months, everyone has those. But if you have a bad run for 5 years, at some point you say, maybe our process needs to be changed. Maybe we need to make some changes. And I think that's where the Fed there's just no looking inward at all to say, hey, maybe we've been going about this the wrong way.
Right. Danny, do you have any thoughts on some of the new Fed contenders, asset, or like how that might be a paradigm shift, or more of the same really from Powell's administration?
I actually, we know that whoever's chosen is effectively chosen to do some or all of the bidding of what Trump wants. I think, that is very concerning. It is a big reason the dollar is weak. It's a big reason we're seeing steepening in the curves every time that, they speak. I don't see analytically too much of a difference between the three. I think all three, I'm not a fan of any of the three, either of any of them. I think, Waller, I can speak about the most is that, he's been at the Fed. He's had this rigid view of inflation this entire time and has been dismissive and transitory in all of these comments. And it seems like when he has these views, he never veers from them or deviates from them, even when the data, looks the other way. And so I find that he's not, he's analytically indefensible from my standpoint. He's had some, he hasn't gotten everything wrong. Don't get me wrong. He's gotten a number of things right, but I think he's analytically married to a framework that I don't agree with. That doesn't make sense. The other two candidates, are, clearly Trump loyalists and Trump, chosen to come in and slash rates. The issue is I think the Fed already slashed rates. And, we've done 175 bips. It's not clear if they're done. There's a limit to how much further you can go. And I believe the real issue, as I've been going through, this section of the presentation, the discussion, the real issue in the economy is inflation. And so I think if they even try to do what Trump wants them to do, inflation will take off. They'll get decimated in the midterms. And then you have to worry about impeachment 3.0. And I think at some point next year, as inflation picks up, it will be too high for them to ignore. And when that happens, I think, either the committee will not go along with what, these candidates want, or Trump himself, for his own survival, political survival and well-being, may flip. Because I think the more and more, they're having, I think it's a good thing that we're seeing from the White House more discussion on affordability, but their way of addressing it is to cut rates, and their way of addressing it is to give cash handouts, and their way of addressing it is things like this. And I just think those are the wrong medicine for the problem, and it'll just backfire. But I could see a situation, very underpriced possibility, that he flips in the other direction at some point when he realizes his approach is not working. And I think that is something that no one considers as a
that's such a good point. Look, if I was the president's advisor and I really was invested in the president not losing in the midterms, as it looks like they're going to do so overwhelmingly, though there's a lot of time between now and then, I would make the same point that you're making, that, look, you're the dog who caught the car. If you continue to force the Fed and give the appearance that the Fed isn't independent. Like, there is a reason why gold is ripping, why we have had the curve steepening, why the dollar is where it is. And it would be interesting if somebody had the ability to get in his ear and say, look, somebody a little more hawkish and a little more credible might be the best thing that could happen to you, because you might succeed in getting long rates down a little bit. You might firm up the dollar a little bit, and you might take some pressure off inflation. And then if you couple that with, let's back off a lot of these tariffs, we'll say for a little bit or whatever, or just signal to the market that you're lowering tariffs, he might be able to save himself.
That's where I land, and we're gonna have to see how it plays out, but should be very interesting, next year. His whole talk about 1% interest rates, just nonsense. He wasn't calling for that even in 2018, and when the economy was doing well. So I'm surprised that his advisors don't push back more, but I think he chose his advisors specifically as people who don't push back more. And so I think that's been part of the problem, frankly. Onto tariffs. I think people have judged tariffs as a number of things, transitory or, whatnot. They're really only about 50% of what they should end up at. And so, number one is, if we look at tariffs, here, this is a couple months older, but it's still intact, similar dynamic. The effective tariff rate is anywhere between 16 and 18%, but we're only around 10 to 11% on the actual realized tariff rate. So some of this is inventory management, some of this is, other factors. On the right, you see the pass through of tariffs to consumer prices is only been about 30 to 35%. Most businesses are telling you that they're going to be up to 70%, 70, if not higher. And so, one, we should expect the effective tariff rate to drift up over time to the actual effective tariff rate. And we should also see the pass-through rate pick up. And so I think it's, way too early to say, what the impact on tariffs is. Now, I think the way I see it is as follows. The tariffs impact both the demand side of the economy and the supply side of the economy in very different ways. And I see everyone focusing on the demand side, but nobody focusing on the supply side. When you put barriers to trade on every single good and sector in the economy, it does a few things similar to, more similar to a Brexit in that it's a permanent change to the economy than it is to the traditional transitory supply shock, which would be oil goes up. And so oil goes up is very straightforward. You spend more of your budget on oil, you have less to spend on other things, demand suffers, but you also get a supply response right away because imagine oil went to $100 today. Producers would sell futures to lock that in the future, and they would then be able to produce and be able to capture higher prices than they were before this shock. And so you get supply pick up. That's how it ends up as transitory, right? We saw this actually in June with the whole Iran skirmish there, where prices went to 75. As a result, you saw, production locked in at these higher levels via selling futures contracts and hedging future production. Whereas with tariffs on the supply side, when you have permanent trade barriers, a number of things happen, and it takes a long time for this to play out. Number one is it's a permanent reduction in manufacturing capacity, right? The more you spend on these sort of dynamics, the less you have to spend on actual production. So capacity declines. The second thing that it does is productivity declines. Again, for the same reason, is that more and more of your spending is on these barriers and input costs to your process, rather than just trying to be the most efficient possible in generating a sales price. So productivity declines. And then last but not least, competition declines, right? You have an easier time competing with foreign manufacturers when you have these barriers. And so as a result, pricing pressure picks up. All three of these forces are persistent inflationary forces. And so I think the tariff regime, the more that this stays in place, will not only have that sort of shift up in goods prices, but it will plateau at a higher level. And that is going to be sticky and persistent in a way that I think nobody else really is calling for. I'm pretty sure I'm the only one who is talking about this. On the demand side, if you think about how this could play out and why I think it won't play out that way, is demand destruction is fairly simple. I'm a manufacturer, I have these input costs increases, and I try to pass them through to customers. I pass them through. Customers say, no way, we're not paying this. Well, now as a business, I have choices, which is either lower how much I'm passing through and eat it in margins, or I start making some material changes to my supply chain to, reduce the impact of these dynamics. And the issue is, if you cut rates before this process plays out, which is what they've done, I think you've completely shortchanged this process. Because when you cut rates, what you are doing is trying to increase aggregate demand. And you're trying to, increasing aggregate demand gives businesses pricing power. That's what rate cuts do. And so you're effectively telling businesses that you should feel more comfortable, not less, in passing costs on, because we're supporting the economy and cutting rates. And I think this is the Fed's mistake, is not letting this process play out and shortchanging it. Secondly, if you cut rates, you're also trying to strengthen the labor market. And if you strengthen the labor market, wages will start to improve. They haven't yet, but maybe at some point. And when that happens, consumers will feel that they have more money to spend than they did before. And that again will feed through to businesses feeling they can pass on these prices. So rather than letting this process play out, I believe the Fed has panicked and cut prematurely and short-circuited, this tariff process. And so far, the demand destruction, maybe it's because it hasn't been fully, implemented yet. It could be that, or it could be because financial conditions have led to this huge wealth effect that maybe that has overwhelmed it. But so far, nominal spending has remained strong, and this demand destruction view has not played out. And I think the Fed has really short-circuited that, shortchanged that.
Yeah, I think you make an incredibly important point there. I think that the Treasury Secretary did an incredible job of convincing the world that this is all a one-time price reset and it would happen fairly quickly. And maybe it never even happened, right? That the importers, that the sellers, the exporters would actually eat some of it. That clearly has not happened. And the rate at which the importers pass through the cost after the accumulation of inventory and all that has just happened much more slowly. But as you've pointed out in some of the other work that you've presented here, intentions to raise prices are going up meaningfully, and they are just accelerating now. And we're going to get a CPI number tomorrow, but it strikes me that it's an incredibly cavalier call without much precedent to lean on to say that we know that inflation pressure from tariffs are going to peak in Q1. There's no way you could have that kind of precision. And the argument that I've made, which reflects a lot of what you're saying, is when you have a world that goes from global cooperation to global competition, that's going to leave, and that cooperation drove disinflation for decades. The other side of that might last more than a couple quarters.
Yeah, and the psychology, inflation is a psychological phenomenon, right? Everyone says inflation is a monetary phenomenon, which it is, but it's also a psychological phenomenon. And in the 2010 cycle, when businesses considered raising prices, they were very concerned that they would lose market share. The psychology was around, we need to maximize market share. Whereas the psychology is completely different this cycle, where businesses are always constantly looking at how much can we raise prices? And, there's a certain level, if we raise them too much, we'll face, a negative outcome. But there's a sweet spot where we raise prices, maybe volumes go down, but our revenues are optimized. And businesses are feeling more comfortable to make these sort of decisions than they used to. And I think that's the psychological impact. And the fact that tariffs have been a bit more gradually implemented, to your point, I think makes the inflation expectation story even more important, because, that is the worst thing for inflation expectations. Is imagine instead of in April, when we had the mess that we did, everyone raised their prices by 20% or whatever the tariffs were for their relative good. I think you would have seen consumers revolt quickly, and we probably would have had a downturn, an economic downturn. But because it's like 0.2% a month or something of that nature, pick the random number, because it's something of that nature, you don't feel it as much. And if anything, it's just, this is a consistent force where you just feel prices going up and going up and going up. And inflation expectations, certainly are not helped by the Fed saying we're cutting rates because we think it's over. And so I think that you have both of these dynamics contributing to elevated inflation expectations. And I think that's the biggest risk for the Fed, by far, is that. And that's where I land on it. Turning to financial conditions, as you know, and as you alluded to in the intro, is a big part of my framework. It has been financial conditions in this cycle. I'll explain my old framework, and then I have built a completely new framework this year, rebuilt the framework. So at a high level, what do we mean by financial conditions? The economy is ultimately driven by, the cyclical dynamics that we have in place, coupled with structural dynamics that we have in place. However, what we have seen is from one quarter to the next, assume nothing drastic has changed, right? No big fiscal deficit change, or no big change to the trade terms, or no big change to any of these things. What you see is we have been getting large moves in markets, and these large moves in markets have a feedback mechanism into the economy, and they drive sequential change from one quarter to the next. So this chart on the left, I love this chart from Piper Sandler, is basically the financial conditions loop. And it was very straightforward from the middle of 2022 until the beginning of this year, where if we would get, better economic data, what you would see is the bond market would start to respond to that, would either price out rate cuts, or the 10-year would move higher, higher rates. At some point, first, equities would take this okay, and then at a certain point, equities would take this negatively. When they would take them negatively, financial conditions were tightening from all corners. We would have higher rates, lower stocks, stronger dollar. And then with a few months, we would get weaker economic data. And then when we would get weaker economic data, yields would move down. We would price more rate cuts. Suddenly, stock market would react to that. And within a few months, we would get better economic data. And we kind of just go around and around this loop in a correcting mechanism every 2 to 3 months. The dynamic that was interesting is that we would either get, using interest rates, 10-year yield, the dollar, and equities, they would all move in either a tightening fashion or a loosening fashion at the exact same time. And so we'd get these huge impulses to the economy up and down. A big driver of this is, of course, you look at household wealth relative to the economy. We're at 5.5 times, and this is as of Q2, so it'll be even larger when we get Q3 data. But we're at well over 5.5 times now size of the economy. And if you go back to the .com situation, we were at 4.25. So we're looking at a material change to the economy where we're more financialized, more driven by financial conditions and wealth to the degree that we have. And we're at the cycle high, very close to the cycle high in wealth to GDP, although we are in outright dollar terms at the cycle high wealth. And so, the impacts from this are very, very large, and they're getting larger by the day. But coming into this year, I changed my framework in a big way. I had to build a number of dynamic equilibrium models to reflect the fact that we were getting policies from the Trump administration that could move growth and inflation in different directions. So in the past, when we would get, an easing in financial conditions, within 2 to 3 months, I would expect better growth data. So thinking jobs data, consumption data, but also higher inflation. And then when we would get better data, you would see the opposite. You get a tightening in financial conditions, and you would then subsequently get the opposite. But with Trump's policies on immigration, think about what that does. It reduces labor supply and should, in theory, tighten wages and raise, inflation profile from the labor market, all things considered. If you look at the trade policy, it reduces, like you said, real volumes, but raises prices. And so I wanted to have a framework where I can look at the impacts from each individual asset class and look at their impulses to growth and inflation separately on a quarter by quarter basis. And so that's what my models do that I share with clients, big picture twists and turns, as well as in dynamics, on a weekly basis where I track them to see how we're evolving. And so what did we see once I put this together? Well, I turned very bullish on growth in June. And the reason was, a lot of people at this point were still thinking, this was a relief rally from the taco in April. backing off some of the worst of the tariff stuff, but the worst was still to come from tariffs and whatnot. And when I looked at the growth impulses, which is the left side of the left chart here, and I looked at the growth impulses, Q2, then Q3, and now Q4, these were the largest growth impulses outside of 2021 that we've seen, going back the last 15 years. These growth impulses were extremely high, were extremely strong and high. And then we also had inflation impulses that were very similar to 2021. Now, this doesn't mean inflation will be as high as 2021. It just means from financial conditions alone, the impacts are on par with 2021. And I think that was a very big deal. And, this should have been in this is effectively a reflation regime. And this should have come with the Fed tightening policy. Instead, they have turned around and said, we don't care about inflation. We're going to support growth by cutting rates to stimulate the labor market. And they ignored financial conditions and what it's saying about the future. And if you take that response from the Fed, that is as Goldilocks as it can get. We have reflation with the Fed not caring about the inflation side, right? Corporate revenues will go up, and we don't care about the fact that their pricing power is going up. That's starting to change. And it's starting to change if you look at the growth impulses. They're still positive in Q1, but less so. Substantially less so than they were. And the inflation impulses, they do slow, but they're not slowing anywhere near as much as the growth impulses are. And so, we're going to start to see, in my opinion, in Q1, a big surge in inflation, and we'll see how the Fed reacts to that. A big issue that I see is that Q4 was probably it looks like in my models, the strongest growth impulse we would have had. So if you think about, Q2 GDP was 3.7 or 3.8%. Q3 GDP is tracking 3.5 to 4%. I think this is consistent that with my models that say we had a substantial boost from financial conditions that took levels. And Q4 probably would have been just as strong as those other two, if not for the shutdown. So we wasted some of the big growth impulses from this. And, that's a concern. Now, as we get to Q1, we'll have to see how it plays out, but we should have slower growth impulses. And so don't expect the markets to be as violent to the upside as they were, even though they should still continue up. But we do have other impulses, to be clear. We have the one big beautiful bill. That tax refund, should impact Q1 in particular in a big way. So I think, there's other things. Doesn't mean that we're falling off a cliff here. But beauty of these models is that I can track these dynamics in real time and see inflection points in real time. And if we start to get to, a regime where the growth impulses are negative and the inflation impulses are still positive, that would be a traditional stagflation. And, your asset class exposures will want to adapt to that.
Yeah.
To me, when I look at the trajectory from here for financial conditions, I think the dollar is the key to watch for anyone who's paying attention to this. So, the dollar sold off very dramatically in April in response to the tariff regime. That sell-off really peaked in July. And since then, the dollar staged, a decent rally until about 2 weeks ago. And the rally in the dollar was a function of, I think, tightening liquidity and other metrics. It went, too far. And it continued until Williams basically gave the green light for the rate cut. And since then, the dollar has started selling off again. I think that's important because the growth impulses from the dollar have been positive the last few quarters, and they turn negative next year. And so the inflation impulses are still, because they work with different lags, are still positive from the dollar. Now, in the last couple of weeks, we've seen a decent repricing lower in the dollar, and if that can continue due to the Fed being possibly too loose on policy, then you may see some of this negative growth impulses unwind and possibly reverse. And that would give more upside to risk assets, relative to what I just showed you, here, relative to this.
Well, just
Any
to better,
questions? A lot here. There's a lot here. So
Yeah.
any questions?
just to understand that better, one of the fears I think that the market had back in April, May was that you would get less foreign direct investment. If it really looks like we have a monetary policy and a fiscal policy that is a weak dollar policy, and we are the beneficiary and need to continue to have so much foreign investment, do you worry that we could have a second coming if we had a dollar sell-off here? Are you worried that you would have repatriation of assets, especially if there is some sign that the level of investment in CapEx and optimism in AI is starting to diminish?
These are the big question marks. I don't have the answers, but I think about them quite a bit. So, that was the concern in April, is that, sell all US, right? So we saw selling equities, of course, as they were implementing this radical policy in such a big way and a violent way, in a shock. But we were also seeing some pulling out of the bond market from foreigners in April. We saw Europeans and we saw also Japan sell some bonds as well. We haven't really seen outflows since that particular violent period. What we have seen is that hedging of currency exposure has picked up. And so, that is going to be interesting to watch through year end, because, it picked up, but it has leveled off. So, for example, the Europeans did do some hedging of their exposures, but from what I can see, Canadians didn't do much, Australians didn't do much, the Swiss didn't do much. And so do we see in year end a lot of these pensions and insurance companies make decisions, and don't act as quickly as institutional investors like hedge funds? So do they make decisions that, hey, at year end we want to raise our hedge ratios? If we do, then we'll see another substantial flow in the dollar, but it'll come in like a pocket flow. Like that flow will last a few weeks or a month, and then that'll end. The other question is, which you asked, very, very succinctly, is, do we see a slowdown in the economy? Does that lead to a dollar weakness? And that is actually really interesting, because typically in a recession, you get the dollar stronger. You get a safe haven bid to U.S. Treasuries in particular, but with deficit at 6.5% of GDP, with a very punitive tariff regime, with inflation that's still sticky. And we know that in a recession, the Fed will radically cut rates a lot faster than they've done in the last 12 months. We know that we'll probably see fiscal spending pick up, even just mechanically, because receipts will go down. Do we see a dollar sell-off in response to a recession? I think the answer is yes. And I think the reason is that foreigners are heavily exposed to AI and tech and the US equity market, and they would want to take some of that money out. So far, we haven't seen money taken out in a recession. I do think, we would see that. So we'll have to watch and see how that plays out, obviously. But I also think, in response to, one of these guys becoming a Fed chair, the fact that the Fed is responding to an inflation shock by loosening policy seems very unwise to me. And that is, I think, part of the dollar move here. And so, maybe the last few months is the break from that, and this continues. The dollar has definitely been weakening in the last few weeks. And if that continues, we can see the impulses, change, not only on growth, but it also raised the inflation profile again. Sure, the dollar is a direct inflation force when it weakens. So That's why I say I think you keep watching the dollar as the key, because I think we've pretty much gotten the most loosening we can out of the bond market. And the equity market really needs these growth impulses to improve.
Mhm.
And it can't just come from the equity market itself. It can. I mean, you can see the market pop 5% in the next 3 days. It wouldn't surprise me. But for it to be sustainable move in equities, I think you need to see the growth impulses improve. And so that really the only one that I see that can change things in a good way is the dollar. If the dollar were weakened.
All right, Danny, that's been awesome. Anything else you'd like to say just to wrap things up in terms of how customers can use you, how people can get in touch with you? As you said, that what you offered here is kind of the framework. This is how you come to the work that you've done, but you've got this long expertise in history of building ways through the options market of expressing this work.
Come check out, Macro Musings. The link is in my Twitter profile. My Twitter handle is Danny Dayan 9. In my profile, I have the link to Macro Musings. I've made it very affordable to make sure that not only institutional guys can get access to it, but retail guys as well. What I do at high level is I publish these deep dive macro thematic notes. These tend to be very valuable frameworks into how to think about economies and markets over time. These are themes that I'm going to be very focused on. And then I have weekly reports where I look at what did the economic data tell us, what can we deduce from that, what do we see as catalysts in the future horizon, like we have CPI this week, what am I thinking for that? And then of course translate all this to markets. Where do I see the risk versus reward being favorable for asymmetric opportunities? And I'll outline that as well. And then on the chat room, you get access to someone who's been a professional trader and how I approach markets and things. I'm very accessible, responsive. Anyone can ask me questions, even on things that may not be my immediate focus. And so, I've really enjoyed, building that. I'll just say, now my next report, which should come out this weekend, is going to be my 2026 outlook. You're going to see some of these dynamics we talked about, but what I'm really going to be talking about is I used to think a lot of this cycle was very similar or a parallel to the 1990s. And there are some similarities to the 1990s, but I'm actually going all the way back to the 1960s now. And I think that we have, the 1960s is where we're headed as an economic parallel for 2026. And so you'll want to read that report, and take a look. I think it's very distinct and unique analysis that you're not going to see from others.
All right. I like it. I do think things have a bit of a guns and butter feel to them. All right.
Very good. Absolutely.
Danny,
thank you guys for having me. Terrific to be back on the show with you guys. I'm big fans of your work.
Oh, thank you, man.
Thanks.
You're the best.
Thanks,
Really appreciate it. Drew, appreciate it.
Thanks.